Hi everyone and welcome to today's video. Thank you for joining me. Today we're talking about should you consolidate debts? For those of you that haven't met me before, my name's Angela. I started the Money Messenger project as a way of sharing some of my knowledge on all matters money. I've been working in financial planning for the last 20 years. I'm an investor myself, so everything I teach you, talk to you about, tell you to do, tell you to steer clear of, I also do myself. I walk the walk and talk the talk. So in today's video, we're going to be talking about whether or not you should consolidate your debts. Seems like a good idea. Sometimes it is, but sometimes it isn't. So let's get started. Should you consolidate your debts? So you've probably seen ads on Facebook, internet, TV and the like with debt consolidation companies offering you services to consolidate debts. They might be credit card debts, car loans, personal loans, things like that. And the idea behind consolidating your debts is to roll them all into one loan to perhaps reduce your interest rate, make it easier to stay on top of your repayments and the amounts you have to pay, rather than having multiple debts over multiple different avenues. Seems like a good idea, and it can be. But there are some terms and conditions and things that you need to be aware of, because it's not always a good idea, especially going through a company which may offer you such a service. So these particular companies that I'm talking about, debt consolidation companies, they've popped up a lot of recent times because there is a problem with a lot of people in the world these days with overspending, accruing debts, personal debts, credit cards, car loans, spending above their means, which means racking up personal debt. So these companies are popping up left, right and center because they can see there's a trend in people getting more debt. That's not a good sign. The fact that these companies are popping up should be telling us all that we need to back off from our spending and back off with regards to taking on personal debt, because personal debt is not good for your personal financial situation. The interest that you pay to the banks, credit card companies is not tax deductible, and really it's a killer when it comes to financial planning. So we need to take control of our spending and lay off the personal debts. But what if you already have some debts? What if you have multiple credit cards already, or car loans, personal loans, and you're struggling to keep on top of things, or maybe not sure which one you should be repaying first, or having trouble meeting your repayments? The debt consolidation companies are popping up, like I said. The problem is a lot of them are not regulated under normal financial planning laws. So they don't have to follow the same code of ethics. They don't have to follow the same laws, regulations as financial planners, for example, or accountants, for example. There's a royal commission that had been going on in Australia for the last year or so, looking into banks and financial planning, financial services, lending, credit cards, loans, all matters relating to money, and really cracking down on companies that promise certain things but don't deliver them, whether it be financial planning advice, whether it be banks charging fees, whether it be people signing up for insurances and products and financial things that they just didn't really need or didn't really want or felt pressure to sign into. So there's a big overhaul of the financial system happening here in Australia. But that doesn't necessarily cover these debt consolidation companies, because they aren't regulated by ASIC, the Australian Securities and Investment Commission in Australia. They aren't regulators as much as some of those other professions that I mentioned. So it's quite easy for them to promise you the world, but not really deliver what they promise. And I'm not saying they're all bad, but there are a lot of spruikers out there. There are a lot of companies out there promising you things and not delivering them. So today we're talking about debt consolidation companies, essentially, and should you use them or should you not? And how else should you go about consolidating your debts? So these debt consolidation companies, usually they promise you to consolidate multiple debts into one. They then may reduce your interest rate with that new loan, or they may extend the term of your loan, which means they, instead of repaying a car loan of 5 years, maybe that's your current loan term, they might get you to repay it over 7 years. And by doing that, it reduces the amount that you have to pay each month, week, fortnight, so that it's easier for you to manage with your cash flow, particularly if you've got some debts that are getting high, getting up there, and you're starting to lose a bit of control over the repayments. The problem is that when you extend your loan term, you're extending the time that you're going to have the loan. So that means you're going to end up paying more interest over the term of the loan, just because you're paying a little bit less off the loan each time now. So whilst that may be better for your cash flow, it can also extend the term of the loan, extend the amount of interest that you pay, and therefore ending you costing you more than you would have otherwise had you just kept your initial loan and your repayments. So whilst extending a loan term might sound good for cash flow, it doesn't make sense from a financial point of view if you want to get rid of that debt as soon as possible and stop paying so much interest. You want to pay as little interest as possible to get rid of your debt quickly. Also, when it comes to these debt repayment consolidation companies, they may change your loan, consolidate your loans with a new loan, which may become a secured loan. So to do that, and that's the way that they can reduce your interest rate, because if they're going to lose out costs as in interest paid to them, they want to have some sort of backup, some sort of guarantee that you're actually going to pay down this loan. So they may change to a secured loan from an unsecured loan. Generally say a credit card is an unsecured loan because there's no security tied to that credit card. So if you don't repay the credit card, there's nothing for the lender to take as security to sell and repay your debt. That's why credit cards and personal loans have such high interest rates, because they're very, very flexible, very, very easy to get, and they're generally unsecured, which means there's a level of higher risk to the person that's giving you the credit card or the loan. So with a debt consolidation company, they'll quite often take your loans, consolidate them into one, and change that from an unsecured loan to a secured loan. Now that could come in the form of taking security over your car, for example, or if you already have a home and a mortgage, it may be that they extend your mortgage to pay out some of your other smaller debts. So that may mean there's more debt tied to your home, which basically means you're increasing the risk of you potentially losing your home or potentially losing your car. So just take note, if you're going to repay that new loan anyway and there's no default on the loan, then it really doesn't matter what's secured to the loan. It's only when you default on a loan and then that lender comes after you for whatever asset you've put behind that loan. So if you default on a debt consolidation loan of $20,000 and you've secured your house to that, that literally means that if the lender wants to take you to court, they can force your home to be sold in order to get that 20 grand back that they are owed. Now, you don't want that to occur. Number one, you're going to lose your home, as in have to sell it. You don't have to lose all the money, but you will have to sell it. Second of all, you don't want to be forced to sell your home at any particular time in case the markets aren't doing well, in case you don't get the price you want for your home. It's just not a great position to be in. Likewise with your car. If a car gets repossessed and a lender sells that through the auctions to pay back the loan that you promised, they will just sell it for what they need to repay the loan, not necessarily what the car's always valued at, the best price for you. They're not concerned with your best interest, they're just concerned with getting money back to pay for their loan. So you don't want to be in a position where you've secured your home for personal debts, for example. That's overboard and overkill, and you're jeopardizing your family home. So with a debt consolidation company, you really need to check the fine print. Also, just know, ain't nothing in this life for free. Debt consolidation companies don't work for free. They will either be paid by you through some fees. They could be upfront fees. They could be ongoing fees to set up the loan for you. They may or be paid through the bank, through whatever lender they get the money from to pay out your other loans. So there is a cost somewhere. Ain't nothing for free in this life. Debt consolidation companies have bills to pay, employees to pay, rent to pay. They don't work for free. So whilst they essentially work for you, if they're getting paid a commission by the lender, whoever they get money from for you, they may choose to get a loan through a lender that's going to pay them a higher commission. So that may not necessarily be a cost to you up front, but it may be a cost to you that they may take on a loan that isn't in your best interest. Like I said, debt consolidation companies don't have to adhere to the same rules, regulations as financial planners, for example, who are meant to work in your best interest. There's actually laws called best interest duties. Financial planners have to make sure you have your best interest at heart. The debt consolidation companies don't have to follow to that. So there is nothing in the laws or legislations in Australia saying that they need to put your best interests first. They may say they are, and they may do that, but they also may not, and there is no repercussion if they don't. So check the fees, check the fine print. If you're in the middle of talking to one of these debt consolidation companies, what's the catch? How are they getting paid? It may be fine to use one of them, but what's the cost? What's the fees? What's the interest rates? What's the term of your new loan? Is it longer than what you're already paying on your existing loans? What's the interest rates? Are there any break fees, exit fees, monthly fees, anything like that? Everybody gets paid in financial services. Somebody gets paid somewhere, so you need to know if they've got your best interest at heart. Also, don't ever take on your partner's debt. If you're a part of a couple now and you're having some trouble with your debt repayment, don't take on each other's debt. Relationships come and go. You may think you're together forever, but at the end of the day, you shouldn't be taking on someone else's debts, whether you're married, whether you're partnered, de facto, whatever. If they're your debts as a married couple, that's different. If you're about to get married and one partner is bringing debts into the relationship, that's when you need to take a look at it. Don't take on debt in someone else's name into your name, because it can put you financially backwards and you don't want that for the long term. There are ways to talk about it as a couple, but do not take on someone else's debts. Even if it's a case of being able to consolidate your debts by putting them in your name, for example, maybe your partner's not eligible for a loan or some other financial reason, but don't take on financial debts of a partner. It's not necessary for you and it's not your burden to take on. So check the loan commission, the loan repayments, check the interest rate, check the terms and conditions. Debt consolidation is not bad. It just depends on how you go about it. If you're going to use a debt consolidation company, avoid ones that are charging an upfront fee or ongoing fees, especially because there have been some issues in the past with certain debt consolidation offers that turned out to be a bit of a scam, because they would charge an upfront fee to get you the loan that you need to repay out your debts, but then for some reason or another you weren't able to get the loan and then they still had their fee. So stay away from those. Anything that pops up online, Facebook ad, that type of thing, I would stay away from those, quite frankly. If you want to debt consolidate, as in putting all your loans into one, credit cards, personal loans, then go through one of the major banks, go through your bank, go through one of the smaller banks, but still one of the very reputable banks in Australia. I would maybe stay away from the smaller companies, because really they have no backing. You don't know who they are, what they are. I would just stay away from them. That's what I would do. If you're going to do it, go down one of the main banks, one of the main lenders' avenues. Talk to your bank about that. Should you consolidate your debts or not? Let's talk about that. Currently, look at your debts that you've got now. Get a piece of paper, list your debts in order from highest interest rate to lowest interest rate. Also write there what the repayments are and what the loan term is. There's a difference between financially struggling to repay your debts, as in you're in trouble, you're behind on your repayments, and just struggling to know which one to repay first. So whether debt consolidation is good for you, it depends on what your interest rates are, is for the main part. So say you have a credit card of $5,000 and it might have a 15% interest rate or 22% interest rate. And then you may have a car loan, say $15,000 at 15% interest rate. Whether you can consolidate those or not into a lower paying loan, say you put them both together and your new interest rate is 12%, that's lower than your current existing interest rates. So yes, it can be a good idea to consolidate your loans in that case, because if the new debt consolidation loan is going to be for a lower interest rate than what you're currently paying, that can be a good thing. But do not take on setup fees, do not take on account keeping fees. The idea is to reduce your costs, so then you don't want to offset that then by paying more fees, as in setup fees, ongoing fees, account keeping fees. That defeats the whole purpose, really. The other thing to keep in mind also is the loan term. If by consolidating your loans together, you're going to be extending the loan term, say of a personal loan, say you're going from 5 years to 7 years, then that's not a good thing either. It may be better for your cash flow, as I mentioned, but it means you're going to be paying more interest in the long run. So that's a no-go zone. If you're not financially struggling at the moment, in other words, you're not struggling to repay your loans, you're not already defaulting on loans, you're not in financial crisis, then I'm talking to you now. I'm talking to the people that are just wanting to get ahead, not sure which debt to repay. You can repay your debts, you're just not sure which one to go about them. If I was you and I had a couple of credit cards and say a car loan, I would find better value in using a balance transfer credit card. With that, you take your existing credit cards, balances, whether it be one or multiple, you can consolidate them together or even just transfer a single loan, a single credit card balance. Transfer that to a balance transfer card, which might have an interest-free period of say 18 months. Sometimes you can get them longer, sometimes you can get them less. I did a video on this recently. I'll pop a link to it in the box below when I'm finished this video. If you can reduce your interest rate on a credit card to 0 for a period of time, that means you can plow extra payments off that and actually chip away at the actual loan debt rather than having to pay your interest costs, which can quite often eat up quite an amount of your repayments that you're making. I would then do that and just leave my car loan as it is for now, or look to refinance your car loan if you can to a lower interest rate. But I wouldn't necessarily consolidate those, because if you can get a 0 interest free period on your credit cards, that nil interest will far outweigh any reduction of an interest. 0 is going to be better than any percent. So I would look for a balance transfer card for my credit card debts, put those all into one. I would try and refinance my car loan, get a smaller interest rate. This is what I would personally do. Number 1, stop accruing new debt. If you keep spending, if you keep putting up your loan balances, if you keep repaying, then spending again, repaying, spending, you're going to go around a circle. You're not going to get anywhere. So the key to getting ahead financially is to stop spending so much and to stop accruing new debt. There's no point paying off one if you're just going to replace it with a new one. You're just going to go around and around in circles. So number 1, stop accruing new debts. Number 2, list all your debts in terms of interest rate, highest or lowest. Get a bit of paper, write down your loans, write down the interest rates and what your minimum repayments are. Number 3, ring each lender, loan provider, card issuer, all of them, ring up each one and ask for a discount off your interest rate. Tell them you're struggling with repayments right now and you'd like a discount. Quite often they will give you a discount, even if it's a small one, but they will give you one because they may be worried that you're going to go to another lender and take your business elsewhere. And they make money on you by having that loan in place. So they don't really want you to go. So quite often they will give you a small interest rate. I've done this myself with my investment loans for my properties. I don't have credit card debt. I don't have personal debt, but I do have investment debt for investment properties. And that's a very different thing. But I have done the same thing. I rang up the bank and I asked them for a discount on my interest rate. And it worked, and that saved me thousands of dollars over the years. So ask each lender, card issuer, bank provider, everyone for a discount. It does work if you ask. Number 4, I would reduce all your repayments down to the minimum for all of your debts. Just clean it all up, go down to the minimum for all of them. You must pay at least the minimum repayment, otherwise you'll go to jail. Otherwise, you'll default on your loans and that's going to cause all sorts of problems. So you must pay at least the minimum off your loans. Then I would pick the loan with the highest interest rate and make extra repayments off that using every single dollar of surplus income that you can find. Any dollar you can chuck at it, extra payment, clear that one first. If you prefer, you can tackle the smallest loan first if you would prefer the confidence and to clear one loan first, which will then propel you to keep doing the other loans. But from a financial point of view, it makes sense to clear the one with the highest interest rate first. Get rid of that one whilst maintaining minimum payments off all your other loans. Next, when you've repaid one loan, repay or snowball all of those repayments to the next debt with the next highest interest rate. So that means all the repayments that you're making off the loan that you've just repaid get snowballed on down to the next loan with the next highest interest rate. Now, if you can manage to consolidate your credit cards using a balance transfer card, that's great usually, because you can get, say, 18 months worth of interest-free period so that all of your repayments are actually chipping away at the loan balance a lot faster than having to pay the interest costs. In that way, it can be a lot quicker to get rid of some of your debts, especially credit card debts, if you can consolidate them all into one. If you can't, because maybe you're ineligible for a new loan, credit card, transfer card, then just stick to your normal existing loans, but do the debt snowball like I said. That's the best strategy that I just mentioned then. That's the easy way to get on top of your debts. It's about reshuffling the repayments that you're already making so that you're paying off the proper loan first, the best loan first, which is the one with the highest interest rate. Whilst it may sound good in theory to consolidate all of your debts, say you've got a car loan and some credit card debt into one. For example, I just saw today that ANZ are offering an interest rate of say 12.5% for a debt consolidation loan, not secured to anything. That might be good if your car loan is higher than 12.5% right now, and your credit cards surely will be higher than 12.5%. If you're not entitled to a balance transfer card, then yes, look to consolidate debts if you like, just to reduce your interest rate. But if you are eligible for a balance transfer card, then at least consolidating credit card debts or moving a credit card debt to a card with a 0 interest rate for a period of time is going to far outweigh a 12.5% consolidation loan interest rate. So it depends on your personal situation and what loans you're eligible for. Credit scores of recently, debt, the way people are able to lend money, banks, lending restrictions are tightening, and that's to stop people borrowing so much. So you may or may not find out that you're eligible for a debt consolidation loan or a balance transfer card. Again, that's why these debt consolidation companies, they're around advertising that they can work miracles at times. Some people are not eligible for new loans. Some people should not take on different loans because of income and expenses. So if a company is promising you that they can get you a loan, and even perhaps another lender may have already told you that you're not eligible for a loan, then I would be wary as well. I don't think you need to consolidate debts all the time to get in front of debts. It's more important to stop spending so much, stop accruing new debt, and then do the debt snowball repayment method that I mentioned. Paying off the highest interest rate first, snowballing all your repayments to the next debt down, the next debt down, the next debt down, whilst also making sure that you do minimum payments off all your debts whilst you're doing that. That is one of the best debt repayment strategies there is. It can be a little bit confusing if you need to always consolidate your cards and your loans. It's not always necessary for you to get in front, especially if you have a few smaller loans hanging around. If you're in financial crisis and you're actually not able to meet your repayments, then maybe you can look at some debt consolidation as well. But the thing is, when you've got a debt consolidation into one loan, then you're only dealing with one lender thereafter. So it's very hard afterwards, in time to then ring up and try and negotiate with that lender or, to try and get a discount because you're only dealing with one. So if they say no, then that's a no. You don't have other lenders that you can call up to at least get some discounts out of some of them. If you are struggling financially now, if you are in financial crisis, as in you're missing repayments all around you, you can't keep up with your repayments, you're not sure what to do, perhaps you're even late on some bills, doesn't necessarily have to be debt, it could be bills, water rates, internet, phone, rent, mortgage, then you need to speak to somebody about some financial counseling, some debt counseling. Now that is very different to debt repayment. When you go and see a financial planner, they will help you to get rid of your mortgage faster and to invest money for your long term. But a lot of financial planners don't deal with debt consolidation, debt repayment when people are in financial crisis. That is a different department. That is a different kettle of fish. For those people that are in those situations, if you're watching this video today, I implore you to get in touch with the Debt Counselling Hotline of Australia. The number there for the National Debt Helpline is 1-800-007-007. Now, that website is www.ndh.org.au. That is a free service. It is debt counselling. That is for financial strife times. That is when you really are out of options. You don't have the option to maybe debt consolidate right now through your normal lender. You're behind in your bills and whatnot. Speak to them first. That is a free service. You should not have to pay for advice when it comes to debt counseling. So speak to them first. So today we talked about debt consolidation and is it worth your while? Is it good to consolidate debts? Short answer for me, I don't think it's necessary if you want to get ahead financially to be able to clear some debts, especially if you have smaller debts and if you have cash flow, the means to repay them. If you are making repayments right now, but just not getting very far, it's more important to shuffle your repayments with the snowball debt repayment strategy that I mentioned, rather than mucking around and consolidating debts all the time. Sometimes that is unnecessary for you to nip your debts in the butt and get along and get ahead financially. So if you're looking into a debt consolidation company, if you've been contacted by one, check them out. I don't believe if people are contacting you for things that you should then do business with them. For example, if you got a phone call on your mobile or a text or a random email, I just wouldn't do that for people that are out there looking for business. If you contacted a company on your own, that's a different thing. You're looking for information. Check them out, check the fees, check the fine print, check the term of your loan, check what the repayments are, because you don't want to be worse off in 5 years than you are today had you stuck to your original loans and just changed the way you're repaying them. I hope you enjoyed that video today. My name's Angela. I started the Money Messenger Project as a way of sharing some of this knowledge with you that I've learned over the last 20 years of financial planning. Please share these videos around. They are free. I'm doing this to help financial literacy around the country. If you like what you saw and want more, please subscribe to the YouTube channel for Money Messenger and also to the website www.moneymessenger.com.au, where I will deliver new financial tips, secrets and strategies to your inbox. That's it for me for this week. I'll see you next week with a new video. Hope you enjoyed that. Bye everyone. See ya.